Welcome, everyone. I am John Ryan, and you have decided to join us to talk about financial futures trading, trading in general, sports betting, the similarities between the two. We're not suggesting in any way that Wall Street is gambling. It is an educated guess, and that's how Steve Merril and I and the folks over at WagerTalk and Sports Memo do our handicapping. And we're going to handicap crypto, for lack of a better word, yet again. And the last time we talked, Steve, by the way, welcome to the show. The last time we talked, we were very concerned about BitCoin in particular and the breakdown and the collapse and the rumor of margin calls hitting some major firms that would really cause big time problems with the Bitcoin market. But we're here in a holiday session, so not much happening, but a great time to really assess the overall conditions and status. Like, is this a buy or do we wait? Is it going lower? Is it going higher? And that's the question that is really running rampant on the Twitter feeds that I looked at. I think it's across the board sentiment is about as negative as you could get is when the Philadelphia Eagles are on a losing streak.
Yeah, I mean, the trend, is your friend until it ends, and it was an uptrend, a downtrend, an uptrend, and now it's a real downtrend. I've said from the start, all the shows we've done, I'm a technical trader. I'm a trend follower, momentum-based technicals. So I really have zero fundamental input. I have some theories, but that doesn't really affect when I go long or short. And the trend's been down, obviously, since last week. I would have preferred that it wasn't such a hard crash on Monday morning because it took me an extra day for everything to roll over in my indicators. So I left a little bit there, unfortunately. Had it happened on Friday, would have been nice, but there's no way to argue that the trend is not down right now. So the question is now, when does it bottom? Obviously, zero would be the ultimate bottom. I don't think that's going to happen. We've talked about 20,000 for a while now. We thought 30,000 was that support. My personal guess was that it was going to break out from there. Once again, that's why I'm not a fundamental trader. That would have been wrong. But I also said if it breaks below 30, the floor is going to be 20. And that's exactly where it's held now for the past week. And what's very interesting to me, John, is that this past weekend, when only the cash markets were open, on Saturday afternoon in particular, it hit as low as the mid-17s. And then by the time we reopened last night on Sunday, it was exactly within $100, about 23 versus 24 when it closed on 20,400 versus 20,300 when it reopened from Friday to Sunday on the futures market, the CME futures contract. So it's holding 20. It tiptoed to 19.5 this morning and overnight, still holding 20. So, it's obvious. It's a critical support level. We'll see what it does the next few days because this is a holiday. So, yes, the future market is open, but the ETF markets are not open today on Monday. So I still think we got to take a couple days, Tuesday and Wednesday, and I would have to see it hold below 20 for several days, maybe by the end of the week. If that's the case, that becomes the new ceiling, and that means 10,000 would be the ultimate support level. So we'll see. This 20 is a very critical level. We might look back months from now and be like, boy, was that a great time to buy? It never went below 20. If it does, though, we're going to have to probably wait till 10 to be safe.
I think so, Steve. I really do. The problem I have intuitively is I do believe in the product. I do believe in the story. And as I learned firsthand from some of the best, including Warren Buffett during the 1998 Taiwanese crisis when he was buying all the banks and everybody was selling them. And he literally was the only buyer of those cheap stocks and obviously did quite well with that one. I feel the same way here that, okay, I can have, I just can't turn a blind eye and buy it at 20 and check the price in 2 years and we're at 150. That's just my expectation that we could be much, much higher. Even if we go up to 90, it's a home run, right? But I have a problem with it because I've seen disjointed markets in the past. We saw in the pandemic, crude oil traded negative $32 a contract, which means that you bought crude oil, 1,000 barrels per contract. They were paying you to take it. It was crazy. And it probably is something that will never happen again, but there's nothing. And that's what I've learned over the 40 years that I've been playing around with this. And you've been doing about the same amount. Not to tell people that I'm older than you or you're older than me, Steve, but seriously, I've seen markets get disjointed and make no sense whatsoever. So, if anybody is thinking that the market can't go to 8,000, think again, because it could. It could also go to 28,000, and that's the $1 million question right now. And I do think it's better to keep the powder dry than to kind of whirl it like you're at the roulette table. Again, sports betting and investing are similar. Playing roulette is a gamble. There's no algorithms in the world that are going to tell you when to bet black or red or the numbers or 00 or whatever. So I think here I wanted to just allude to this. The purple lines are a projection of what the potential max high and low could be for that particular day. So you can see when we had the sell-off, and these are big moves, folks. I mean, it may look small on the chart, but they're huge moves in terms of dollars lost. You see that the bands get wider, and that's because of the implied volatility, and the price action is such that you have to expect that. It's much like in an NBA game. You get a couple of games where a team is scoring 240 points, and the implied volatility of that game is going to carry over into the future games. And that's where you potentially get that bet for the under because the market is overreacted. Now we're starting to, we kind of narrowed here, right before the big drop last Saturday, as you mentioned. And now these lines are big. The gap here is basically 16,750 up to 25,000 is a max potential range for tomorrow. Will it hit that? I don't think so. But that is the mathematical projection for a market that is completely nuts and has no reason for doing what it's doing. As long as this continues to narrow, that's going to set the stage then for the breakout. And whether it's going to be the continued downside here or not that story is yet to be told. But the story right now, this picture is telling you, like you're looking at a piece of artwork at the museum, is that, as Steve said, the market is down. You'd have to be standing on your head to think that this is a bull trend. There's no other way to describe this situation here where my arrow's going through. And moreover, this line here in the Stoudemire profile is enormous. It's specifically 29,912, but we round them up because nobody's exact with trading like that. But resistance is going to be incredibly big between 27.5 and 30,000 on the upside. So, it's one of those situations that if it rallies, it may stall there, and then what? Or it could go down to 14, Steve, and then what? That's where I'm kind of like, it's a game that if this game was on the card today, I would pass.
Exactly. I mean, people have been asking me where will it be a year from now, and I can make a 50-50 argument either way that it's going to be near 30 or it's going to be near 10. So where's that put the average? If we're right on either one of those, 20,000. Where's it sitting right now? 20,000. What's the key support level I've talked about all along? 20,000. It's a 50-50 coin flip if that's the case, and I honestly believe that is. But once again, I'm not a fundamental trader anyway. That's not how I base my decisions, but I can still analyze it from that aspect. And I think it really is a 50-50 coin flip. And if that was the case with a sporting event, when you're laying a 110 to win 100, you need to hit 52.4% to break even. We would pass. So I think you're exactly right. And one other thing, my prediction, my guess of where it'll be over the next year is range bound. And I think it's going to be very unexciting, to be honest. And the reason I say that is, with these other markets, when they don't move for a while, that's when they break out. And when they're extremely turmoil and they start to kind of settle, they stay that way for a while, and Bitcoin has been incredibly turbulent for the last couple years. But keep in mind, it was kind of quiet for a year or two before that. And, once again, the future contracts are what I look at. It's what you look at. But we also have a new element over the past 6 months or so. We have very liquid ETFs now, which you can go long or short. Now, I realize most people are going long only, but you still could short those. And that's why I'm not reading too much into what happens today on Monday with the stock exchange close, the future market open. It's kind of a half trading day, basically. I think Tuesday and Wednesday will be very telling, and we'll see where we are this time next week, and we'll know a lot more. If it closes in the mid-20s and holds all week, I would say 20 is the floor. If it closes below 20 and holds for several days, I'd say 20 is the new ceiling. So I'm kind of taking a wait-and-see approach over the next week.
Yeah, I agree. I'm gonna just I enlarged that chart to just show the most recent month and a half, and I want to get back to full blown chart here. Might actually have to go to another chart. That's the S&P 500. We'll get to that in a second. But, the sentiment reading here on the bottom, and hopefully everybody can see it. This is an equation that is something I learned on Wall Street a long time ago and tweaked it over the years. It's also now prominent on a lot of the platforms that you can get, like TD Ameritrade and the rest of them. But I customized it. Told I'm pretty good with numbers, Steve. That's all I'm going to say. But I do the same thing with the sports betting markets, and I'm able to get a lot of intelligence out of the Twitter feeds where I search through 2,500 tweets, say on Dub Nation, for example, Golden State Warriors when NBA season is over. But it's just an example where it'll then produce a pie chart, neutral comments, positive comments, which would be betting on, or negative comments. And when that sentiment reaches extreme levels, meaning 70% positive, that would be the analogous to 70% bulls in the marketplace that we saw at the top not too long ago in the NASDAQ and the S&P 500. Everybody and their brother was bullish at the top. And for whatever reason, these events happen and the market makes tops when everybody thinks it's going to the moon. And conversely, when everybody thinks, prices are going to continue to go lower and lower and lower, that's the environment you get the bottom. So if you look at this sentiment, and I know, Steve, you know all about this kind of stuff, you can see the troughs, down low here. Even though the market rallied here, you still have a chance to be patient and buy back. You could have bought 50% of a position here and then added on the pullback. And that's the key. You get a line like this, an engulfing candle. As you can see, the low is lower than the previous day's low. The high is higher than the previous day's high. And the close is higher than the previous day's high. That is a potential sea change, meaning that the trend has been down and that we're going to expect a rally of some sort. Well, it rallied. And, it doesn't look like much, but significant. It rallied about, 12,000 from the midpoint of this range. But then we got more patterns that indicated that, well, wait a minute, this is not trading like it's going to go up to here. It's trading like I should get neutral and just see where everything is at. And the engulfing candle is what I'm looking for in this situation, Steve. And I think the volatility is, you're not going to have these small bars on, and today's closed, obviously that doesn't count, but the recent trading here is almost like the market's taking a deep breath. It's exhausted. It's out of breath. It just ran the marathon and it's trying to find its breath to stabilize things before the next event happens. And that's the event that we don't know. But anyway, sentiment right now is at the lows that were seen at the previous bottoms. Like, look on, it's not immediate on any given day where you decide, I'm going to be buying, I'm bullish, I'm this, I'm that, it's going to the moon. It's a grinding type of thing. It's almost like, and I'll throw the Angels out there. And I did this with the Phillies. The Phillies, and it wasn't because Girardi got fired. It was because the Phillies were statistically, analytically in my models, one of the most undervalued teams I had seen in the last decade. And I play an arbitrage where I'll take the division leader and sell them, which was the Mets, and then buy the Phillies. And that lead was 12.5. I think now it's down to single digits. And I expect that to converge. The same exact principle applies here. There's no difference other than I'm looking at a chart of BitCoin versus a chart of the Philadelphia Phillies or the Mets. So
Yeah,
I'll let you speak now for a while, Steve. Sorry about that.
No, it's I was pulling up some baseball info actually because I agree. I mean, the one difference with the Phillies is that statistically, I like to look at road only stats because every team has played 65 plus games now. They've all played 30 plus on the road. It takes all the different stadiums into account. For example, you got to take out Colorado's home games. You make them look like a very good offensive team. So I always look at road numbers only. One thing you look at this time of year, this year only, is you can look at the league-wide. You used to have to do NL and AL because obviously the NL was 8 hitters versus 9 hitters in the AL, but now everyone has the DH. But anyway, if you look at batting average, Colorado, we'll just see OPS, which is the overall on base plus slugging, is the best overall metric probably. Colorado is 28th out of 30 when you look at road games. So, that's why you have to take out home parks. But I bring that up because the Phillies have been up there all season long, and now that they've had a little bit of a winning run the last few weeks, they're actually the best offensive team in baseball if you look at OPS on the road. So they had some potential. They've been top 5, top 10 all season even when they were losing. So, yeah, they were due to play better, and then I think that was the catalyst, maybe the lineup. The manager changed because they always say you can't fire the lineup. You can't fire the entire roster. You can only, that's why they do that in hockey and basketball. And it is a spark. Now, the Angels didn't get quite as much of a spark initially. They lost, and then the next night they won, and that snapped their 14-game losing streak. And we talk about falling knives. By the way, BitCoin, a falling knife the past week. It's exactly why there's no other way to argue, but that was a downtrend. It's the epitome of a falling knife. And the Angels were a falling knife as well. So what do you do with falling knives is you don't try to catch them. You wait till they hit the ground. And even then, it might bounce up and still cut you, right? So you let it settle. And then once that falling knife is kind of flat and nobody cares about it anymore is when you start to pick it back up. And that's what you look for with BitCoin right now. And like I said, I need to see another week or so of it kind of settling. I don't need to see another 5,000 move up, 5,000 move down, because that means that knife is still hot. Maybe we should talk about trying to catch a hot falling knife. That might be the good analogy. Let's trademark that one, John. Because I was going to say, if it's a rubber knife, a rubber knife is bouncing, but then a rubber knife wouldn't cut you, so I didn't go with that. That's our trademark here. We got it on video, so no one can steal it. A fiery knife, because it won't cut you once it hits the ground, but it'll still burn you if you try to pick it up too soon. There we go. Steve Merril original. Yeah, we're going to run with that. The Angels, though, were a team that you had to kind of bottom out. I actually faded them yesterday on Sunday and was wrong. They shut out the Mariners, so does look like maybe we're getting some buy signals with the Angels now. And this is a team, don't forget, this is a good Bitcoin analogy as well. Like teams like the Cincinnati Reds, they went, 1-20. They were 3-19 overall, lost 20 out of 21. They have picked it up a little bit, but they're still one of the worst teams in baseball. The Royals and Tigers are going to have these monster losing streaks too. The Orioles did it last year with the worst record. They lost 20 straight road games. Those teams should lose, but what's so fascinating about the Phillies, like you said, is they were one of the best offensive teams in baseball all year. They were due to play better. But the Angels are very interesting to me because this team was 27-17 a month ago, leading the division, and then they lost 14 straight. 27-17, first place in the division, and lost 14 straight and 18 out of 20 right after that. So it's not like they were one of the bad teams. They were actually a playoff team that all of a sudden got terrible. Bitcoin's kind of like that, right? Bitcoin's been very strong for 2 years now. It's got some long-term upside still. It's not like Bitcoin isn't like a company that's going to go bankrupt, I don't think. I mean, blockchain is here to stay. Whether Bitcoin is blockchain or not, you can make an argument, but I still think they're the leader in that industry, or whatever you want to call it. So, yeah, I think Bitcoin's a lot like the Phillies and Angels that are playoff caliber teams and are in a little bit of a slump right now. But the question is, when do you get in?
Yeah, I agree 100%. The Angels are definitely on my radar. And, they're definitely on paper, and there's a difference between paper trading and reality too. But it does help you identify potential targets. And, and the Yankees, conversely, are going to be entering that fade stage.
Right.
And I know that's scary as hell to say. And that, John Ryan must be out of his, mind to be thinking that, but it happens, and they are scorching hot. Atlanta Braves are scorching hot. The Phillies, however, are one game behind both of them for June records. And I like your take on using the road only because that really does make the playing field equal. You look at the all-time records in baseball for batting average by a team over the course of a season, and you'll see the Colorado Rockies a lot, and it's because of that home field advantage where they play there 81 times a season, and the most anybody else plays there is about, 9 times. So that's huge, and that's a good point for people that are just starting out in the sports betting markets, let alone cryptocurrencies. But this is crude oil now. I'm going to pull up here real quick. And I think this market is topped, and I know that's markets always top before the news outlets tell you. And I'm not saying I'm better than the news outlets. What I'm saying is that the picture is telling me that the way this is shaped now and this dramatic sell-off, which is in another engulfing candle, if you see, here's another one right here. I'll just enlarge this a little bit. Now you can see it there, right there. That is that's textbook, because it took out not only the previous day's high, but it rallied higher than any of the previous days, period, in that rally. And it failed. And a market that makes an extended high in a trend and fails is a warning sign. There's no other way to call it. The picture is saying, okay, we got a warning sign. You get no rally attempt the next day. It basically goes down. Then it goes down and it rallies. That was kind of like, well, maybe it's just going to stabilize. But then we had this thing, and that's a big candle. And now, if we get through this high tick chart here in the profile, at least it's going to go down into the low 80s. And whether it gets to test here at the high tick at 71 is another thing. But just think what that means for the economy. Over the next couple of months, we're going to get through the vacation season. It stands to reason that prices here will drop. 71 is not 50 by any stretch of the imagination, which is where we originally came from. But it could take the overhang that the market has in the S&P 500 of the fear for inflationary trends to be outrageously bad for the foreseeable future. I do think, Steve, from my experience with being a currency strategist for a long time, I would have preferred the Fed to do 100 basis points in tightening instead of 75. 75 to me historically means, well, we know we have to do more than 50, but maybe 100 will be too much and the market will tank. The more you do, and we go back to history in the early 80s with Paul Volcker and that Federal Reserve coming out of the era of price freeze idea that conceptually and academically should have worked. It didn't. It backfired. It failed miserably. No fault of anybody. It was what it was. But then that forced the Fed to really have an aggressive hand. And thank goodness we had a guy like Volcker in there that wasn't afraid to do what had to be done. And he took rates up to 22%. So, I think of it this way, Steve. You'll find this. I know you'll agree with me. When we're coming down in mortgage rates, historical average over the last several decades is basically like 7.75%, 8%. So we start dropping deflationary trends. It hits 5%. And all of us are thinking, holy cow, man, this is unbelievable. This is great. We go even lower. Now that we've we bottomed and now we're starting to come back up. Now we're at 5%, and the consensus, the sentiment is, oh my God, interest rates are so damn high right now, I can't even believe it. But not too long ago, a couple of years, when we came down through 5, everybody was having a party. And Bitcoin is the same thing. When it was new and it was trading only a couple thousand and it reached 10,000, it was like, oh my God. Then it went 20,000. Oh, isn't this great? And 60. But now that you come back down, the 30 seems like, oh, geez, man, wow, this is bad. And I've always been fascinated with that. And I think that's what creates these highs and lows. It's the betting behavior of the human being.
Yeah, I'll put this into perspective for you with Bitcoin. So year to date, 5.5 months, right? 5.5 months from mid-June, Bitcoin is down 58%. What a terrible investment, right? Year to date, exactly last June, it's down 43%. So the past year, you've lost half your money. Past 5 years, it's up 735%. And for the life of it, it's up 6,100%. I mean,
yeah, that's exactly right.
If that's not the forest from the trees, right, like you're talking about. And I'll go a step further with the mortgage rates. You're right, they're below the long-term average, and they're like exorbitantly expensive now at 5-6%, and they're not even at the 50%. Less than 2 years ago, John, as you said, oil went negative. It's now over $100. Less than 2 years ago, we were talking about if our interest rates would go negative. They'd already done so in Germany and Europe. I mean, you look at this stuff, once again, you just got to step back and look at the forest from the trees sometimes, and it's just absurd that in that little narrow box, we were worried about negative interest rates, which never made any sense to me, but it wouldn't have surprised me if it happened. I had no opinion. I thought it was 50-50 at that point. I mean, the world was insane with COVID. But yeah, I mean, that was a good buying opportunity. And I still think there's tremendous, I mean, rates, the 10-year, if you want to throw that one, I mean, it's just the trend following's been great with rates. Let's put it that way the last 3 or 4 months. As they've just exploded. And in hindsight, it was a no-brainer. Same with oil, energies, natural gas. I've made a fortune on all that stuff. Bitcoin, I think, like I said, I think Bitcoin is going to be boring and you're going to basically get chopped in and out. It's going to be a choppy zigzag market for the next year. I think oil and natural gas will be in the next year a sideways choppy market. These trends run like this, it has to cool off. It's just the way markets work. They can't be bipolar insane. It's it's like a 5-year-old. They can't run around all the time 100% octane. They got to take a nap at some point, right? Markets have to take a nap. That's a new one. I'm coming up with some good phrases. I'm trademarking all of these, man. We're archiving this show so I don't get anybody plagiarizing me. But all seriousness, you look at the mortgage rates. The Fed is obviously way behind. You're exactly right. What I find comical, John, I was telling some people this last week. They've already telegraphed. Well, they already did 3. They did 3 quarters. They already telegraphed like 11 rate hikes right over the next 2 years or whatever. So they know that has to be done. But instead of doing it, they spread it out over 2 years. It makes, well, I mean, look, and I get, before people start commenting, I get why they do that, because it would probably crash the economy if they did it all at once. But I find it kind of comical that, like, the doctor knows the treatment, but they're going to spread it out over the next 2 years. It's just purely political reasons. They didn't do this stuff sooner for political reasons because they wanted to get reappointed. Now that Powell's been reappointed recently, I'm hoping they'll do the right thing more aggressively. But, I mean, I don't want to say they're not smart. They're smart people. But I know a lot of smart people that have no common sense or street smarts. And I almost feel like that's how these Fed guys are. They're bookworms. They've been in their cubicle their entire lives. But I think more so than that, I think there's just political pressures. It's not an elected position, but it's an appointed position. And there's no question that they didn't want the party to end 2 years ago. That's when the party should have slowed down. They started flickering the lights 2 years ago that the cops were coming. They didn't do that. They kept drinking until 4 a.m. and now it's 6 a.m. and they're feeling the repercussions of it the next day, the next week, the next year. And I still don't see how this doesn't end very badly, because I've said that for a year now, and I'm usually early on those predictions, and I still might be a little early. But so much for Bitcoin, by the way, being the great inflation hedge. As I mentioned earlier, it's down 50 to 60% over the past year as inflation's run. I mean, what a joke that's turned out to be.
Yep. And the talk of the soft landing type of thing, by definition, you can say that we're in a recession right now or we're not.
And they just said 40-some%. They just upped it to 40% chance we're in a recession. You're exactly right. It's a 100% recession. I don't know if it's a textbook recession. I honestly couldn't tell you right now what a technical recession is. We're in one. If we're not in one, we're going to be in one, and it's going to be bad. I don't care what they want to call it. When they say there's a 43% chance in the next year we have a recession, it's a joke. There's a 100% chance people are going to be hurting. The middle class is already suffering big time from gas and food inflation. So it's like, what's it matter if it's a technical recession? I mean, it just doesn't matter. It's like people are having trouble with money. That's a recession in my definition.
Yep, I agree. And it's like choosing the MVP between Tatum and Steph Curry when they were like plus 280 and 200.
Right.
It's 100% probability that Curry's going to get it, and he might have gotten it even if they lost.
Yeah, that would have been. I wanted to see Boston win just for that reason, John, because he should have still gotten it had it gone 7 to like overtime or something. I mean, but the only thing is they wouldn't have done it. But I mentioned that earlier in the season because of the series. I said if you like Golden State minus 160, you play Curry minus 115, at least half of your bet, because I really saw very little scenario where Iguodala was going to win it again at 100 to 1 or Kevin Durant was going to show up and win it. So, and the sentiment vote there for Curry was off the charts. Wiggins obviously gave him a run, especially when Curry had a bad game 4. But yeah, I totally agree with you, because Tatum did not step up. And that, of course, is why Boston didn't win, because Brown and Tatum weren't consistent. But I definitely think he should have gotten it no matter what happened in that series.
Yeah, Tatum is the structural recession that people say we're in.
Yeah, good point.
And Curry is, I don't know what that would be right now as an analogy. But
Curry, in my opinion, I think the U.S. is going to be okay still. I think we're going to flush out some of these idiots in the midterms, and they're going to have to, and then the ones that stay are going to have to start actually doing stuff that serves the country and the people, not their self-interest. And the 5 or 10% woke groups on either side that push the narrative. But my concern, though, John, and something we haven't talked about, though, is that the dollar is I don't think this is going to happen overnight, but if the dollar isn't the world currency, the reserve currency in the future, we got big problems. And the way Russia and China are kind of teaming up concerns me a little bit. And I feel like that's going to be something we're going to look back 5-10 years from now and be like, boy, we should have seen this coming. We're screwed. Little things like that. These aren't things that happen overnight once again, but we get distracted by stuff that's not important. And all of a sudden, people forget, like, the one power we have still in this world is the dollar.
Yeah.
I mean, that's how we keep China in line. We're not going to do it militarily. They're bigger than us, and they got a bigger army than us, and they're crazy. I mean, they don't give a damn. So it's like, in Russia, too. But they don't, these leaders don't want to go broke. So, like, that concerns me. And the dollar surged the last couple of days. I know you're a currency guy, so I'd love to get your thoughts on that. I mean, the dollar got stronger all of a sudden. It was short term, but we'll see what happens.
Well, that's the Euro futures right there, I believe. No, it's not. It's let me go back to the Australian, New Zealand, Canada are commodity-based countries. So this chart is actually telling me that the Fed now may be actually ahead of the curve. That doesn't mean that what you say, Steve, isn't going to end badly. It means that it's not going to be like Brazil was 10 years ago.
Right.
Or like we were in the late 70s.
Well, I think that's the one. I think the 70s analogy is the one to try to figure out if that's happening or not. I think that's the one that would be most realistic to the U.S. just because it has happened.
Yeah, I agree.
And once again, Brazil and Peru, when they had 10,000% inflation, it's like their currency was never valuable like the dollar. That's the one difference with the U.S. versus banana republics. Yet, with that said, like you said, we had a stagflation. I still don't see why that's off the table, John, personally. I mean, I think we're due for a stagnant economy, and I think inflation has already hit. I don't see that. Prices are never coming down. It might level, but like I've noticed it at the grocery store, like it's happened overnight. Like they held on as long as they could, and they literally raised stuff 100% the last month or so. Yeah. I mean, it's just like boom. It wasn't incremental. It just went 100% up. Eggs, potato. It's like, and you're only talking like $1. It's gone from like $1.80 to $2.80. The chip's gone from like 70 cents to $1.40. But like, I pay attention to that stuff. I'm a numbers guy like you. I just love numbers. And I'm like, it's only 70 cents a bag of chips. That's not going to make or break anybody. But that's a 100% increase on something non-consequential. I mean, something ain't right. Yeah. I mean, I know in your life and my life, I've never seen that happen. Within 2 months, something goes up 100%.
Nope.
Something is not right in the marketplace.
But this is the Aussie. So if we actually started seeing price go up, and when price goes up, dollars down. So when interest rates are being raised, the dollar should get stronger, which is what is reflected in this chart from this point to here. And this is a pretty big move. It's like a 10% move in the Australian currency, which hurts them. And that's the double-edged sword with this thing, the fiery double-edged sword, because not only do higher interest rates here hurt us on a global exchange, it also hurts the commodity-based countries, as I mentioned, New Zealand, Canada. It makes it harder for Japan to do business too, because they import 100% of the oil, and so does England. And they don't have oil wells. They don't have oil refineries. So they import everything. And when these pockets of irrational behavior in the price action occur, it really affects them big time. And, the Australian economy is a big one, but it's not the U.S. economy. It doesn't have the strength. It doesn't have the foundation that we have. It's just a totally different world. This is the New Zealand. So they'll run pretty much in tandem, but the New Zealand runs a little bit weaker than Aussie. Aussie is always going to be worth more. But the sentiment here again, we're down in this area where we turn up, and then all of a sudden, Steve, you could be absolutely right with the stagflation assessment. And that is a very real possibility. And I think that actually would be worse than just having the Fed raised
And what do you
interest
think the
rates
sentiment is on
2%.
that? I've heard maybe that mentioned 1 out of 100 times. Like no one's talking about that either, which makes me. It's not like to me,
Yeah.
it's not a black swan event. I think it's obvious, but there again, it's the stuff people aren't talking about. That's what's not priced in or they're not looking for. Everyone's talking about a recession or higher interest rates. That's priced in. Like
Yep.
you're saying, they already know that. That's why the move was months, weeks before the Fed actually makes the announcement because it was a 98% implied chance that they were doing the 3/4 cut. And that, by the way, John, they probably should have done one, and maybe they wanted to do one, but they weren't going to do one because they're just slaves to the market, and that's kind of why once again the Fed cares about the stock market for political reasons, for reappointment reasons, and because they don't want a lot of turmoil. So it was a foregone conclusion that they're going to do 3/4. But what's so scary to me is that wasn't a foregone conclusion until like a week before and several weeks after the previous meeting when they said they're going to do a half, which means they're kind of followers. It's almost, or they're throwing little
There's no
chips out there
question.
to see what they do to the market. Like, hey, let's put a little hint that we might in a week from now do 3/4. And when everything's settled in, they went ahead and did 3/4. Had it not, they would have only done a half. It's just very
Yep.
phony.
Back in my early part of my career in the late 80s and then all of the 90s, the euro market, the euro futures, which is still probably the biggest and most liquid. It just doesn't move very much because the interest rates are so low.
You're talking about euro dollars, just so people realize, right?
Yeah, it's the LIBOR rate,
Yeah,
London
yeah. So
Single Bank Offering Rate.
people are going to think you mean euro as in the currency. That wasn't around in the 80s and
That's right.
90s. Yeah, the euro dollar is basically similar to the overnight Fed funds. It's very, very slow moving, right?
Yeah, but back then, that was what we looked at to see what the Fed may or may not do. The market in the 90s then started doing everything for the Fed. So
Right.
it literally was the marketplace telling
It's
the Fed
self-fulfilling
officials
prophecy.
basically, okay, you got to tighten 50 basis points the next meeting. And then you look further out on that curve of the LIBOR rates and et cetera, and the short-term rates, Europe versus us, and it tells you what the Fed's going to do. And to your point, that's exactly what's happening now. Um,
It's the tail wagging the dog. It's a
yep,
self-fulfilling prophecy, whatever analogies you want to use. Yeah, it's
the cart before the horse, or whatever that analogy is. The knife that's not falling. I have no idea what else to call it,
well,
but
that's also
that's the
why,
fact.
John, we could probably, history rhymes. It rhymes, it repeats, but it more rhymes than repeats. History rhymes instead of repeats is a phrase I like to use. And
Yep.
there again, that's the one big difference between the 70s and 80s is that that's not how the Fed was back then. Now, like you said, it's a day late, a dollar short more than it was back then. So you also wonder how much they can actually change stuff like they could back then, if that's the case. It's almost the tail wagging the dog, the market leading the Fed, where it's supposed to be the other way around.
And the market's much bigger and much stronger than the Fed. I used
Probably,
to. I
I'd
mean,
almost say smarter too. I hate to say, I wouldn't have said that in the
well,
70s and 80s,
market's
but now
always right.
the market is
Market's never
smarter
wrong.
now. Right.
I remember, back in the days where Fed intervention in the currency markets. I mean, I don't know how else to describe it than the activity of doing something into or against a wind without being foul. I mean, it is the greatest exercise in futility to try to stand in front of the world's largest foreign exchange market imaginable and think that you have the clout to make the market do what you want it to do. And that's why you never hear it anymore. The European countries, before they joined, would intervene on their individual country currency and literally get their faces ripped off. It was almost a sign to do the direct opposite as a trade.
Right.
When they started, to support the Swiss or something, it was a sell signal. Anyway, I wanted to point this out before we end the show. Heating oil. We have an engulfing candle here, and I'll make this our show, not best bet, but our show trade of the day, I guess. I think heating oil is going to go down lower. I'm not saying that it's going to go back down to here, like $1.89, but I do think that you have about $1 move lower over the remaining 3 months of the summer. Or we're just beginning the summer tomorrow, actually. But there's seasonal forces in place here that would cause heating oil to go down. The crack spread, which it is passionately called, it's been that way for ever since the pit days of where you saw the guys trading like this with the hands, and which is something I did. That's the spread between crude oil, unleaded gas, and heating oil. So that has seasonal tendencies now too. And even if I'm right, Steve, it doesn't mean inflation is under control. It's more the food. It's more the clothing, especially the clothing. Those are the things that everybody has to buy. A lot of people just have electric. I have heating oil and electric, and not everybody's dependent on it. Unleaded gas, however, everybody is dependent on that. So even if it goes down 5%, 10%, even 15% from where unleaded gas is now, that doesn't mean that things are all of a sudden great. Right, probably not.
It also, and normally when oil goes down, I mean, it's a sign of a recession. So normally
all the underpinning demand. That's exactly
right. Oil, stock and oil long term is not too correlated, but logically, it's like copper. Copper's really hit down hard recently, and the economy's going down, the stock market's going down, rates are going up, stock market's going down. That's another thing that's counterintuitive. This is the worst year ever, like in 100 years, for the 60-40 portfolio, which I have nothing to do with, by the way. I don't trade that way, as I've mentioned, but it's only like, it's the worst time ever. It's only like the fourth or fifth time, like in 100 years, it's been this bad or something, that they both have been, negative at the same time. And so it's just, things are different, obviously. And that's another sign to me that this isn't like something we've had in the past. It's like, normally if rates are going up, that's because the economy is really strong and healthy. Oil is going up because there's a lot of demand. The economy is healthy. It's the opposite because we have a weird supply chain issue and a lot of other things. Quickly on energy, something I've thought was fascinating. No one's been talking about it at all. I haven't heard anybody in the talking media mention this, but I've been following it for a while. I mean, natural gas, if you looked out till next year's contract, like I'll do the short term and I also do the longer ones because I get a little bit of a non-correlation there. You look at the front months are like, it was as high as 9 a couple weeks ago. Now it's down to like 6.5 natural gas. But if you go out to just next April of 2023 and then October of 23, it's like 6. Now it's 4.8. So next January was still like 9, just like the front month. But then you go a couple months out, once again, when the winter's over, like you're saying, and it was saying next April was going to be like 6, and then next October 6, and now we're down to 6.5 and 4.8 in those other months. So like there's a huge difference between the next 9 months and next year's natural gas, which told you this was probably a top. And same thing with oil. Just today live on Monday, June 20th, front month oil is about 109. This December is like 100, 101. Next December of 2023 is like 88. And it's been like that because those are the ones I trade. When I do my trend follow, I split it out with the front month and a couple years out, as long as it's a liquid market. And it's been like that. I mean, it's been a good $20 difference between right now and 18 months from now in the future markets. So
that's a slowing economy.
And normally it should be the opposite, right, John? I guess that's backwardation, right? It should be contango, where something should be more expensive 18 months from now in a normal economy, correct? So, and not only is it less, but it's like, you're talking about like 20% less.
That's correct.
And that's oil like 18 months out. But natural gas is the one I thought was fascinating. You go all the way till January, it's the same as right now, but you go to next April, it's like 20% less. And I know that's because the winter's over, but still, it shouldn't drop that much just because the season, which it's basically saying it's going to be really expensive till we get through the winter, and then it's going to be, boom, back down to normal. And once again, the markets are the indicator because people are putting real money behind this. People, nobody out there, the only person who wants to lose money intentionally is a fool, and they're not going to have any money. So, like, anybody who actually has money to invest cares about keeping their money. Is a 99.99% chance of that. The reason Congress and politicians are awful is because it's never their money. It's our money. It's tax money. Everything they do in this country is tax money. It's the epitome of other people's money. And what do you do with other people's money? You spend it foolishly and you waste it. And the Fed is also not using their own damn money. And for the most part, they're wealthy. They're not getting crushed by gas going up $100 a month for them. And that's exactly why the markets are much better than politicians or the Fed. It's because you're actually risking your own money on your opinion, and people don't want to get it wrong. And people at that level are pretty smart. Otherwise, they wouldn't have enough money to move markets too. That's another takeaway.
Yep. This is natural gas futures right here. You have an engulfing candle at the top of this move. Here's a second one, and here's a big one. So to your point, this probably is going to continue down into these levels here. The red bar right here is $4. So now let's put up, say, June of next year.
All you have to do is go to April or October of 2023. Those are the two very liquid contracts. Just go to April, which is only, 9 months from now, 10 months from now. It's 4.8, which is exactly what you're talking about. And that's where that little gap of like non-volume is there. So I think that's a fascinating level.
Well, that's June of 23. I couldn't find like
Yeah, it's the same thing. But the chart is identical, so nobody would notice if you look at the chart. But if you look at the price levels, tremendously lower. And of course, that's all that matters to the average American is like, what's something going to cost? That's the only positive, John, I can say for inflation. Why I don't think it's going to get any worse. Because once again, everyone's talking about it now, right? You and I were the only ones talking about it a year ago when they were handing out money to everybody, their brother and their sister, and 2-year-olds basically during COVID. I was like, how is this not going to cause massive inflation? And that's why I knew trend following was going to work well. And everything has run for the past year and a half, and now it's probably peaked. So, like, you're not going to make money going long commodities anymore. If anything, you're going to probably lose money going long commodities because everything is 6 months to a year in advance. So maybe this is the light at the end of the tunnel. Maybe this is the regime change when we get some new politicians in here in the next year. And I think the markets are showing us that maybe, and that's a good sign that natural gas and oil are rolling over. The only reason that would be a bad sign is if we're having a massive recession or something coming, I guess. Which the odds say is only 40% once again, so that's probably a good sign.
And I highly recommend don't pay attention to the odds. I mean,
I know.
It's almost something like if somebody tells you that there's a 70% chance that a given sports team is going to win a particular event. It almost makes me want to take the other side. I was trying to put up the spread there on natural gas. We can do that for the next show because I suspect that spread's going to be contracting. Because the big heavy bar on the profile was $3.07 versus $4 for the current.
Right.
So that spread, in other words, the front contract is going to underperform the back.
Well, that's still about a 25% gap, which is what I've noticed. So that would be exactly right.
Yep. And then lastly, this is the S&P 500. So conceptually, we have a little doji here on Thursday, little follow through on Friday. But again, notice because of the volatility in these downdrafts, the projected range here is extraordinarily large. But when we're in downtrends, it rarely hits that upper band. And conversely, when we're in uptrends, it's more likely to be like this, challenging the upper band. So with this market, again, like your upside is right here, the first line, 42.25. So you're going to put retirement money in place at 37.25, basically, with an upside of only 500 points when you're, it could go to 4,200 and then it could go down to 2,500. I mean, that's the danger here. And that is
if you look at that too, like there's no uptrend in that picture whatsoever. I mean, there again, it's like just eyeball it. It's like nobody can make an argument that the stock market is not in a downtrend right now. I don't care if it's a bear market. This whole bear market thing is so ridiculous. I guess it's technically 20% down. That's all they talk about. I don't think I've ever heard one guy on TV say it's a downtrend, which is all I care about. I don't care about if it's down 18 or 22%, whether it's a bear market or not.
Well, a lot of those guys must be standing on their head because there's no way you could say that this is. I mean, it's looking at the picture of the Mona Lisa, and you say that no, that's not the Mona Lisa. That's Farrah Fawcett.
Right. Well, the other thing too is this is all technicals, but I mean, from a fundamental aspect as well, like it's still pricey. I mean, because earnings and stuff, and if there's any kind of recession once again, then that's going to get even worse. So I don't see, other than buy and hope, which is how most people invest, unfortunately, I don't really see much of an analysis where you can make a buy case right now.
I agree. And again, the tops, which I deleted this part just to make the bars bigger. The sentiment was up at 82 on the reading, which was the highest, including 1998, by the way, that I had seen. And now we're at 22.4 and going down. I mean, this line is clearly downtrend. Am I right, Steve? Is this a downtrend right here, this gold line?
Oh, yeah. I mean, it's once again, how could anybody argue against that? And look back about a couple of weeks ago, you got that green doji right in the middle there.
Right here?
No, farther to your left at the bottom there. The lowest point of the purple right there. Keep going to your right. Now back.
Here.
Yeah, that one.
Oh yeah. That's
Look
that.
at how telling that was. It bounces off of that, and then look when it finally broke below that, where all the red ones are to the right. There's actually a gap right at that spot, which it is yet to fill. And then look at the volume, the stardom of the indicators on the right, the blue there. That's like the smallest gap too. I mean, how fascinating is that? There's so many different things correlating right there.
Yep.
What level is that, John?
Right.
What level is that open close on that candle? My guess is that the 40s, or is that the 42 or 38?
That is an open of 3,900.
Wow.
Low of 3,807. So
yeah, because I was going to guess 38 because a lot of people have been saying 38 and 42 are the two key levels. Boy, that doesn't show that 38, 39 is that key level. I mean, right there, it rallies from there. When it finally breaks through, there are gaps below it on two monster red candles. So, I mean, my guess would be if there's any bounce, it's going to get back up to that and fail. So, I think the risk
maximum.
Yeah, so you're talking about like a couple $100 in reward versus unlimited risk.
Exactly right.
I mean, if you're looking for a reason to short, once again, this isn't how I trade. It's just I'm not a fundamental guy, but once again, if it bounces anywhere up to that little gap, that'd be a great short. But I still think it's probably a good short from here. Put your short it now. Put your stop loss right above that level, like at 4,000. You're risking a few hundred for a nice little drop down if it goes.
Yep. And the fact that this is so heavy on the top,
right,
the bars and the heavy volume that is given this picture, it's going to take probably 12, 18 months, in my humble opinion, for prices to go from here and start challenging here or have the strength to get through it. We have to go through the pain and suffering of more downdrafts and chopping around and getting the market stabilized and consolidated before you can start a new one. 1981 was the beginning of the biggest bull market ever, and events were chaotic. It was not, intuitively, human nature, you would not have bought stocks during 1981 or even 1982. Interest rates at 22%. Everything in their common sense wise told you that was the wrong time to do it. But that, in investing in sports betting, sometimes is the time to do it. And I don't know what the explanation is. I've read God knows how many books on behavioral patterns, and it's fascinating. It's fascinating what we do as a herd.
Well, I think it makes sense because look, it's a zero-sum game, and there's got to be a buy for every sell. So
people don't get that.
Yeah, but it's very simple. I mean, if nobody wants to, if everybody has sold over the past couple years, it can't go any lower. And I don't feel like everyone has sold yet in this market because it's still way up from the COVID low. It's way up from all that fun money that came in the second half of 2020 when the government handed out free money to everybody. There's a lot of people that could sell still. That's where Bitcoin gets interesting because that's why I think 10,000 is that rock solid line in the sand. 20,000 might very well be also. If it's not 20, it's going to be 10 because that's the serious long-term people that have been in since it was in the 2000 range. Like, they're just not going to sell at that point. But anybody that the breakout was at 20, that's why support resistance works. It's not voodoo. I mean, people, these charts work because it's price action. And as you said earlier, the only thing that matters is price. And look, everything I trade is based on price action. I use different indicators that we're talking about on the shows necessarily, but it's still price action. There's no fundamental guessing on my part what the market's going to do. And that's why I'm pointing out these key levels here because that is buying and selling action. There's got to be a buyer for every seller. And that's where the sports markets are a little different. You can get literally 90% of the bets on one team and 10% on the other, and that's what you cannot get that in the financial markets. It's theoretically impossible because you have to have a buyer for every seller. And that's why I think it makes a lot of sense that things rally when it's the ugliest because it's capitulation. There's nothing left, and that's where the stock market is right now. It's nowhere close to that. And there's a lot of people that are still up a lot of money right now and they're not panicking yet. But when it goes down another 1,000, we'll see if they start panicking.
Yep. I agree. Whoop. I didn't want to do that. Slip of the mouse there. But anyway.
Because there's a lot of people that have made money that haven't sold yet. You can see how little the volume is recently versus where it was even higher. I mean, the people that sold at the top level there were basically getting out at the top, and more power to them, man. They made a good decision. But there's a lot of room to fall.
Yeah, there is. This is probably a good spot to end today's show, I think. How about you?
Yeah, it's good stuff. Good
You got
stuff.
anything big going on $9 Monday at Wager Talk?
Yeah, I got a baseball best bet for $9 Monday Wager Talk. I'll be hosting for the Prez tomorrow on Wager Talk today on Tuesday, filling in for him tomorrow. So check that out, Wager Talk TV, wagertalk.com, and all those shows are archived 24/7. Also sportsmemo.com, sportsmemo TV as well.
Sounds very good to me. I don't know if you know this, but I finished #1 at Sports Memo in the NBA for the full season.
Nice.
So with my co-host Ronald Kabang, he was #1 last year, and we do the NBA triple double show. So that ought to be hopefully a pretty popular show come next November when we start up NBA again. But we got a whole bunch of stuff to go through before that, and football is right around the corner. I'll be starting football shows pretty soon. In fact, later this week, actually, start looking at the futures, and
Awesome.
we'll talk about it on Manny's Pub too, which starts today at 4 o'clock. 45 minutes of not random guests, but guests such as yourself and Tony Finn, Rob Vino, Tony Mejia, Dr. Chuck, Jesse Scholl, Kevin Thomas. I know I'm forgetting some. Rocky Atkinson. And it's a pub atmosphere. You stop by, you have a beer, or you can have a glass of water. You don't have to drink alcohol, but you give your 2 cents, and it's a discussion. It's a little bit laid back, kind of like this show, where the format is not so structured that you have to be like every 2 minutes doing something. But it's always great having a guy like Rob Vino on, for example, where he is not a numbers guy. He's fundamental analysis, and as you know, I'm pretty like 85% analytical and then 15% fundamental. But there's a million ways to skin the cat and be successful at handicapping, as there is strategies for investing. So probably a good time to say that, we're not professional financial advisors by any stretch of the imagination. Doesn't mean we're not qualified to give out advice, though, from our experiences, which we think and hope to be helpful. But you got to check with your CPA or a financial expert that you trust before doing anything, especially if you're going to start tailing our trades. Last thing we want is for a trade not to work and you didn't understand what the heck you were getting into. So with that heating oil trade, to short it, that is something that you just kind of want to watch, especially if you've never heard of the position or the term short or any of that stuff. It's better to watch and learn than it is to go through the pain of a losing trade, because it's the first one that you've ever seen. Lots of caution. It's major leverage, and it's not for everybody.
Yeah, I agree. If you're not comfortable doing it, you don't understand it, you probably shouldn't be doing it. I'll leave it at that. Educate yourself and paper trade, start small and then build up. That's how all the greats have done it.
Yeah, and as Tony Finn says, the greatest quote ever is do everything in moderation, excessively.
Yeah, I was just say moderation and Tony Finn are not similes. That'll be my closing thought.
Love it. All right, Steve, I'll let you go. We may do one tomorrow, especially if volatility in the marketplace is such that it warrants a show for an update. I suspect that one of the days this week is going to be rock and roll time somewhere, and we'll have lots to talk about, of course. So until then, make sure you get over to WagerTalk and check out Steve Merril's profile page. He's one of the best on the planet, and as well as my profile page over at sportsmemo.com. And I think you'll do quite well with the sporting end of things going forward. So remember 2 things: bet and invest with your head, not over it, and may all the winning trades be yours.